Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the forthcoming FOMC meeting taking place on Wednesday, the 31st of January. Slap bang in a week that is going to be dominated by big tech earnings, but we also see the likes of the Bank of England and the Federal Reserve come out with their latest monetary policy decisions. We see Eurozone inflation coming out, and we top off the week on Friday with the latest US jobs report. So plenty of volatility across the board likely. But in terms of the FOMC meeting, markets really have to decide whether they think the Fed is placed to cut rates over the near term or whether they're going to have to come out with a more hawkish tone because of the fact that they're still some way away from target. Certainly, it looks like the ECB are going to hit target before the Federal Reserve, yet they're coming out with more hawkish stance, while the Federal Reserve recently seems relatively happy to allow markets to get a little bit carried away with themselves. Let's look at some of the underlying stats. First and foremost, here's the jobs picture. We have seen the payrolls number rebound last time around, but by and large, if you look at the declines over the course of the past 2 years, the bottom section of this chart highlights that we've just dropped back into this range that was essentially the pre-pandemic range. I wouldn't necessarily think that it's anything to worry about at the moment. If we start seeing payrolls below that 100K mark, then it's more of a problem. But as things stand, we're just back down to a relative norm. And the same can be said for unemployment. In terms of the unemployment rate at the top end of this chart, whilst we've seen a number of different factors that often correlate with unemployment turn higher, and that would indicate a potential rebound in terms of unemployment, we haven't seen that yet. On this occasion, I can show you that we typically see the core CPI reading, the job openings number inversely correlated with the unemployment rate. And despite both of those moving lower, we haven't actually seen a rebound in unemployment. So the jobs market looks fine as things stand. Now, in terms of the GDP figure, we've seen the wider growth figure at 3.3 recently. So stronger than expected, well above that 2% that was expected. So again, not too much to worry about on that front. Then we look at things from an inflation perspective. This is the headline CPI breakdown. 3.3% was the last reading that we've seen. Of course, well above that 2% target. A few things to draw your mind to here. First and foremost, the bottom section of the chart essentially says that the trajectory seen over the past 6 months is essentially where we are at the moment, right? 3.32 for a 6-month annualized figure. That's pretty much where we are at the moment, 3.3. And that really does highlight the fact that it's going to take some time to strip out some pretty chunky figures that have happened over the past 6 months. August, we saw 0.63. This is the middle section of the chart that I'm looking at. 0.63 in the August figure, 0.4 on the September, and now December came out at 0.3. Add them all together, you've got around about 1.3% of inflation out of 3 months alone. And so once we get up to August, September, we see those stripped out once again, then things are likely to dramatically fall. But I don't think we're going to get back down to that 2% target anytime soon. You can certainly see that we're coming up to a couple of chunky figures in terms of the January 0.517 and the February 0.37 numbers. So near term, we could actually see a nice bit of disinflation. I just think we're probably likely to get down to sort of mid 2% rather than actually getting below 2%. And then it comes down to whether the Federal Reserve is happy with it there and is happy to make a move sooner rather than later. The core reading's interesting because we've just seen the core PCE index coming out on Friday. That came in towards the downside, now at 2.9. So that steady downward trajectory continuing. Something I've been highlighting over recent months is the fact that the core PCE metric is much better equipped to reach that 2% target over the near term compared to the core CPI reading. And you can see that at the bottom because we've got the 6-month annualized of the two. 3% for the CPI reading, but that core PCE number, 1.9%. So we are on track as it stands to get back down towards that 2% target. But that's in 6 months' time. So the question mark here is, will the Federal Reserve be happy enough just moving on a few months down the line and then thinking, well, we're on a trajectory to hit that 2% target? Arguably, you might say that if we hit that 2% target and then see the Federal Reserve taking action, it's going to be too late and they're going to overrun their target in the opposite direction, much like they did on the way up. So they could act early. How early remains to be seen. And certainly, if we're looking at the expectations of markets, you can see that markets are currently pricing the March meeting as essentially a coin flip, 52% or 53% expecting a rate hold. But the remainder, so essentially 48, 47% expecting a rate cut. So any change in pricing around about that March meeting will be notable. Bear in mind, we don't have an April meeting. So markets are essentially saying, yeah, we're definitely going to see something in May, just 9% attributed to a rate pause for May. But nonetheless, that repricing around about that March figure will be key. And so in terms of what we're looking out for in terms of the chart, let's get a couple of important markets here for you. First and foremost, the US dollar. We have seen it rebounding of late as people start to consider the possibility that we could have to wait for a little bit longer in terms of that first rate cut. Now, I think in terms of this, the trajectory of this, we haven't necessarily seen a breakup through this big resistance level, this first major swing high that we can see here, which is at 104,263. Until that happens, there is a possibility of some downside, and certainly the repricing around about this meeting. If we were to see the likes of Jay Powell coming out and essentially pushing back on the idea that we're going to see a March rate cut, then you could see some upside coming into play here as we see a risk-off move coming into markets and a potential push into that 104,263. But certainly a break through that level would be required to give us a wider rebound. And certainly if we were to come out, see the Federal Reserve coming out with a little bit more of a dovish sort of tone, I think there's a good chance that we do see this market start to roll over once again and continue this bearish trend that has been playing out at the back end of last year and not necessarily the beginning of this year quite yet. So that's things in terms of the dollar index. Then I wanted to show you things in terms of the S&P 500. We have been pushing into record highs. The daily time frame shows you this recent rally into resistance, as we can see here, breaking into this 49.02 resistance following this symmetrical triangle. So trying to close out the week in a positive fashion. I would say Tuesday's earnings are going to be really notable coming ahead of the FOMC meeting. But by and large, markets in an optimistic mood as things stand. And unless we break the 48.59 mark, a near-term retracement could give a potential buying opportunity for the bulls. If we break below that level, then you're looking for a more bearish outlook over the near term. But until that 48.59 level breaks, I think any pullbacks are viewed as a retracement within an uptrend that has been playing out of late. Optimism seems to be abound within markets, and let's see what the FOMC come out with, because ultimately the tone from the FOMC should shape expectations around a March meeting that, as things stand, is essentially a coin toss. And we really need to gain greater clarity. The FOMC will want you to have greater clarity. They want markets to be priced correctly because it essentially avoids major volatility. So this is an opportunity for them to correct us and tell the markets we're not going to see something in March, or tell us, well, now that we're seeing our favored inflation metric on a trajectory that is in line with the idea that we're trading at that 2% region within 6 months, that could embolden them that if we see the same thing over the next couple of months, that they could be in a position to cut for the first time in March. So keep an eye out for this FOMC meeting. I will provide a number of different previews over the course of the week, giving you a heads up on how I see things in terms of some of these other major events. But certainly this should be a week to remember with plenty to sink your teeth into, and the FOMC meeting is just one of them.